Peter Cardillo, who's chief market economist at Spartan Capital Securities, is joining in. Peter, help contextualize this, because I think this is reinforcing the expectation that the Fed will soon act to curb rising inflation. Where does the market stand? Give us a sense of both the equity markets, the bond markets, and, well, how everybody else around the world is looking at the US.
Well, let's first talk about the data today. Obviously, the top line inflation was ugly. It was more than we expected. However, core rate came in less than expected, and that's the key. And if you look at the PCI, year over year came in at 6.5%, basically unchanged. So while the top line number was ugly, we can say that perhaps sometime in the beginning of June that will probably reach a peak level in inflation. And I think, that's why we see the markets reacting the way they are. Before the numbers came out, the 10-year note was trading above 282, and now it's trading back down to around 272. So basically, I think the markets were expecting for a higher core rate, which obviously means higher inflation in terms of the consumer and in terms of inflation sticking. So this leads us to the fact to what will the Feds do? I think they will continue to remain hawkish. I think we should expect a 0.5% rise in May, which I think is probably a near certainty, and most likely one in June. The reason is they're behind the curve. And the reason why we're seeing the markets, at least the bond market, in total turmoil is because the Feds misread inflation. So they put themselves in a very awkward situation, and in a situation where the markets have begun to dictate to them. So therefore, they will not change their hawkish tune, and they need to at least catch up to the yield curve. And if they do that, then I think, we'll probably see the markets respond to the economic growth and, of course, to the war factors, which could be a problem.
How difficult is it at this point to predict how economic growth is going to pan out? Because certainly the Fed has to take cognizance of inflation. It is going to act, as you say. But there are some worries that 2023 could be a year where the US economy sees a recession. Is that fear something that is broad-based, or is it something that is only being spoken about in whispers as of now?
No, I agree with that. I agree with that because, look, interest rates are going to go higher. There's probably going to be a total of maybe 5 hikes, 2 of which are going to be at least of a half a percent rise, and barring any worsening situation between the Ukraine and Russian war, and I say barring that is because there's an outside chance that Russia gets totally isolated, and some countries in Europe may just pull back on buying gas and oil from Russia. If that happens, that could very easily send the price of oil to 125, perhaps maybe 150. And that, of course, would throw a curveball in terms of what the Fed is expected to do for now. So as interest rates go higher, obviously the cost of money goes higher, and that means the consumer will be forced to spend less because the debt load becomes more expensive. And so we're probably headed for a recession in 2023, although it'll probably be a very mild recession. a recession that you go in and maybe in a month or two, you're done with it.
All right. Thanks, Peter, for joining in.